Hello, and I welcome you to today's webinar here in the Trading Spotlight webinar series together with Admiral Markets. My name is Jens Klatt, and I'll be the moderator in the upcoming 45 minutes around with a very, very fascinating topic, especially in the current market environment, high volatility. In fact, everyone is watching gold. You probably have seen the developments over the last days. So there were brokers sending out emails saying we only give limited access, if access at all, trading the markets due to physical gold shortage, in fact, resulting out of the coronavirus. Spreads widening, and what I can say is that Admiral Markets wasn't affected by this, so there's still the possibility to trade gold. But if you carefully watch, you can see the disruptions here between the paper gold market and the physical gold market when looking at the spread, which is a very good indication. Usually it's a very, very tight spread, very liquid market, and right now all the developments around the world around the coronavirus are bring us to a situation, bring us into a situation which hasn't been there before, and which is in fact worth giving it a deeper look. The fascinating thing is the strategy I will present to you today works in the basic version without a stop loss. Why is this noteworthy? It's noteworthy due to the fact that it makes it very, very important to formulate a clear risk money management based plan on clear rules and also on a mathematical approach we introduced already several months ago and in another Trading Spotlight webinar with Monte Carlo simulation. So in fact, it's a very, very tense situation right now. Also with the shutdown everywhere and social distancing, we have to stay at home, but still it also delivers tremendous opportunities to see strategies work in real life, how they work and where adaptations are needed and why they are needed, in fact. And that's what we want to look at here in the upcoming 45 minutes around. So before we start, let's have a look at today's agenda. So first of all, I'd guide you through the characteristics of gold. A very simple setup then, which looks, in fact, very, very simple in the real world. In fact, it consists out of an entry position you take at 1 day in the week, and then you close it 1 day for 24 hours later, in fact. And that's, in fact, the profitable strategy I want to present to you. Now you might probably say, okay, did he just say he enters the trade 1 day in the week and he closes it the other day and then you can profitably trade gold? Yes, this is what I just said, and you will see it based on a back test for over 20 years here. I've run via Python, so you can easily program the strategy based on available data. By the way, it's possible end of day data, use it from gold, use it as the data you just analyze, in fact, and then you play around with the data a little within Excel, but also as I did in Python, and you will see it's in fact working pretty well. And still, the current market environment with all this liquidity issues here, the huge swings we have seen, and you will also see it's as a strategy 2 weeks ago. I bet that you'd become very, very nervous given the massive sellout in gold at this day on the 13th of March. Just have a look at the chart and also the days before, and it would have been very, very difficult for you to keep a clear and clean mind during that time, not become too emotional. And that's why these adaptations then at the end are so important from a risk and money management perspective. So that's me. So I don't want to give too many details around me. That's probably not very important here. If you are interested, I recommend to you check out the YouTube description box after this webinar. Once it's uploaded on YouTube, there's an interview I gave where I did together with Admiral Markets, and it shows where I come from and what's my personal background, what's my professional background. and yeah, it gives you some insights in my life, how I became a trader. In fact, I think it's more important here to shine a light on Admiral Markets, the broker which makes all this possible here, Trading Spotlight webinar series. And a broker which is right now one of the biggest FX CFD financial service providers in general in the world, as far as I know, at least. Offices in over 20 countries around the globe. So that's noteworthy because from a support perspective, especially right now with this high volatility, you probably might come across questions and you want to talk to someone who is fluent in your native language. Chances are very high that you reach out to someone at Admiral who is talking your respective language. So we are here, right, in an English-speaking webinar, so that's probably not such a big issue to find someone talking English. But when it comes to finance, I mean, or when it comes to money in general, I worked at the bank, and I know that this is a very, very sensitive topic, in fact. And people sometimes just feel more comfortable speak to someone in their respective language. It's most of the time we're talking about costs of doing business, spreads, low commissions, which is also, by the way, one of the aspects why you should definitely give Admiral a deeper look, because this is on top something where the offering from Admiral is top notch. In addition to that, I can say that right now, even though there's some big swings in the markets, I'm not really surprised, to be honest. But since I knew that Admiral is a very, very trustworthy broker, it's also in regards to regulation, then, for example. But when you really find out whether a broker is holding to its promises it makes from a marketing perspective, when yeah, let's put it simply, when the shit hits the fan, right? And right now, to see the stability within the platform, auto execution, speed, slippage, yes, it's a topic, but it's not such a big issue as reported from many others in social media. Right now, brokers have shutting down their platforms, not granting access. All this is not an issue right now at Admiral, and this is one of the main reasons I highly recommend having a look here at the broker. So that's just from me as a personal note. And now let's dig into the characteristics of gold, and let's shine a light on today's topic. So what we clearly all see or know is, in fact, that gold is the biggest market of all precious metals. So this is mainly due to its exceptional value storage and properties and numerous industrial uses. So that means it's a highly liquid market. That's very important. This is very important, especially from a risk and money management perspective. Why do I have this here in bold? Since we will, and this is something I'd like to emphasize right at the start here, we won't work with a stop in the basic version of this strategy. So why is liquidity a big issue? Because it becomes unlikely that you see massive sellouts or that you see something like flash crashes or something like that. The more liquid an asset is, the more unlikely it becomes that you get to see something like that. Certainly, there have been occasions in the past once really liquidity was a big issue, and also in addition, right now especially, and not only that, but also that there have been some bigger swings in gold, for example, even though it's such a liquid market with flash crashes happening. But all in all, it's very important if you formulate such a strategy that you make sure that the asset you trade this with is highly liquid, and you don't need to worry here about this. And it could get an issue, or become an issue, in fact, once you're trading other precious metals like silver, but also palladium, platinum, all the other precious metals which may come to your mind, which are tradable, but still are not as liquid as gold is, for example. That's one of the reasons why we formulate this strategy here for gold. And then there's also something which is currently especially of interest, because it's often viewed as a safe haven for investment, and it's most demanded during times of economic uncertainty. And the demand is naturally higher once risk aversion among market participants increases. That's also something we should keep in mind in regards to the strategy. It's at least the basic theory behind this, because the strategy I will present to you aims to capitalize on this safe haven demand over time, which manifests then, and the signal is generated shortly before the weekend, in fact. So trying to profit from this uncertainty, which is given naturally due to the fact that over the weekend markets are closed, and then you try to somehow hatch your portfolio. So that's the basic, the theory behind this. Still, I'd like to dig a little into the common mistake to say it's a safe haven per se, because what you probably have seen over the last weeks here in regards to this coronavirus, and especially the uncertainty where the economy will head to, all the uncertainty resulting out of the fact that the economy shuts completely down. No one really knows when the economy will come back to life, and also whether the not just trouble, but the what's the word for this? Disruption is the wrong word. Whether everything will be the same, or if there's not such a let's call it broken environment in which you have trouble gain trust again in whatever business. So this is something which is should naturally result, based on this point here, in a high demand for gold, and gold should shoot through the roof. Instead, look at the chart from the beginning of March onwards on. You had a massive sellout in gold, in fact, and that resulted out of the fact that there was a liquidation taking place all over the place, and market participants had, for example, to meet margin calls. So they are positioned in equities, for example. Equities are under tremendous pressure, and in this moment, market participants who also had, to some extent, long positions in paper gold, future gold, for example, they sold out these positions to meet margin calls to keep their positions going. That's one thing. In addition to that, there's also this, what we can call this liquidity issue given by the currency system we are living in, and the natural US dollar shortage we have in markets. And there's a pile of debt which was built over the years, over the last decades, in fact, and probably especially after the great financial crisis hitting us in 2008, and after the Fed nearly went all in with buying assets here, especially treasuries, driving yields lower and everything. So have this zero yields environment. There was masses of liquidity being pumped into the markets. And that resulted in in a US dollar shortage, in fact, because the money was to some extent given out as a credit, if you want. And now, once here the situation gets tense and market participants have to meet their payments, they have to stay liquid somehow, and that's why they demand everything back they can easily sell. For example, gold positions, for example, equity positions. So everything you get to see right now is classic for a massive risk off, and it's something we have seen already. In fact, in 2008 it has been the same, because in 2008 there was also this let's call it deflationary shock which hit the market, so which is currently driving the gold price lower despite the safe haven status it has. Well, now the thing is, we are looking at the paper market. So we are not looking at the physical gold market. Right now, try to buy some physical gold wherever. So for example, here in Germany, in Berlin, the city I'm living in, the gold shops are closed. And once you say, okay, I'm trying to use online shops, you not get anything there. It's like they are open between 8 to 10:30 a.m. in the morning. In fact, then they have to shut down because there's no further physical gold supply available which can meet demand from people. So you have to wait till you get your physical gold. And this has resulted in something which is now of interest, because this supply, or this shortage in regards to gold is given through the fact that there's a natural component within the paper gold market, in fact. So when you trade gold future, for example, at the CME, Chicago Mercantile Exchange, gold future, but also if you trade certificates, if you trade CFDs, for example. So we have the classic cash settlement procedure. So once we go long in a gold CFD or gold certificate or whatever, we don't demand the physical gold, but the liquidity providers do have the opportunity to do so. And now the thing is that the CME has not enough gold available to meet the part where market participants say, I don't want my gains being cash settled here, or my positions being cash settled. But what I want is I want you to sell me the physical gold instead. So and now the thing is that the gold bars are not available anymore. So the paper market has grown to an extent where it's now nearly or close to impossible, in fact, to meet the demand in terms of physical gold, which means that the CME now sees a massive liquidity dry out due to this fact, because liquidity providers don't trade gold anymore, or only allowing you to close open positions, but not open new positions anymore. Because now, just imagine you're trading with someone who has taken the other side of your trade, liquidity provider. So you are trading gold long, and you have a demand, and the one who's selling you the gold now has to meet the demand in terms of physical gold once it becomes possible for the counterparty of the liquidity provider then to demand the physical gold. And not only that, the market, the paper market, has grown to an extent which is completely crazy, but in addition to that, now we have fears around the coronavirus that also precious metal refineries will be closed due to the coronavirus, because they think it will also spread there naturally. So they close down everything which produces also physical gold, for example. So the physical demand cannot be met. And this is currently driving the market completely crazy and result in a fact where the physical gold price, in fact, is not dropping as much as the paper market is dropping, or has dropped, by the way. So we have seen now a tremendous a run higher due to the developments around the Fed, for example. But this, in fact, that has nothing to do with the strategy I want to present to you, but just to give you some background information on what's currently going on and why this point here needs further explanation, in fact. So when we talk about normal market environments, then yes, gold is a classic safe haven. But right now, you see the complete opposite when looking at the gold price at your chart and see the big swings in one or the other direction, especially once equities sold off so sharply as they did at the beginning of the month, and gold fell too. So that didn't make sense at first, but now it probably makes sense because it's a liquidation issue. And the current big swings and wider spreads you see in your trading platform result out of the fact that the paper gold market has completely decoupled over the last years from the physical gold market, where now market participants step in and say, you know what, I want my physical gold. I'm not willing to take your US dollars due to the skepticism whether the US dollar will be worth something in the future, given this bazooka which the Fed just delivered. I mean, that's very very polemic, but still something I could imagine everyone to really easily understand. So still, let's come back to the normal market environment, which this strategy worked well in. Also, it worked well over the great financial crisis. You will see this once we have the backtest, because the backtest covers a time frame of 20 years. So that obviously includes the great financial crisis. So now let's have a look at the setup itself. I already said it's a very easy setup. It's nothing spectacular. It's very, very simple. The strategy is easy. We buy gold every Thursday at 21:59 London time. So 1 minute before, in fact, we enter this FX closing window, or rollover window, we can call this. So we buy at the closing price or 1 minute before the closing price of Thursday, and we sell the position on every Friday, one day after. So we hold the position 24 hours, and shortly before the market closes here, we sell the position again. So we hold it just 24 hours. We have no stop loss, we have no take profit. Again, the stop loss question is something we definitely have to deeper look at, especially in the current market environment with these huge swings, in fact. And I will give you an idea based on that, given these so-called Monte Carlo simulations we went through already in the past within this Trading Spotlight series. Still, I'd like to point out the high liquidity aspect here. And now, again, the high liquidity aspect right now is an issue. Usually it's not an issue. You remember that makes it unlikely that you get to see something like a flash crash. Still, the past has shown that there is sometimes such bad developments in the market. Again, which why we need to probably work at least with a worst case stop, or with an adaptive position size then, in fact. So that was the first aspect. The second was in terms of safe haven status. And now imagine what's going on here. Why should this work? I mean, the strategy itself should have an idea which makes sense. So why should this work? Where does the safe haven status from gold comes into play here? And this is something you can see here. So market participants, for example, hedge their exposure and build long gold positions, for example. This is first aspect we just mentioned. The second is just imagine a physical gold trader, which is in fact not speculating, but which wants to hedge his exposure into the next week. He wants to make sure that he gets a certain price he can calculate with and he can do business with. So what he does is he fixes a price before the weekend to make sure that he can then, in the next days, in the next week in this case, deliver the gold as requested from his trading partners, in fact. So what he does then is he already buys the gold, the physical gold, before it has to be delivered next week. So he has it available at the start of the week. So that's the second idea behind this. In fact, very simple and completely understandable. So now let's have a look what this delivers, in fact, respectively. How does it look in the real world first? So let's have a look at the chart, even though I think it could be it is self-explaining. So if you buy gold here, that was the example from Thursday, in fact, Thursday, the 6th of February to Friday, the 7th of February. So I prepared the presentation here in February around. So that's one of the reasons why here you have an hourly chart now. You do not see such big moves. And also here, once you look at this, you can see this is 27 cents, in fact. So you have gold at 1,568 and then 6.69 and here 0.96. So it's 27 cents spread. Right now, the spread, sometimes it is as small as it is right here in this picture, but meanwhile, you have seen tremendous widening of the spreads due to what I just described, the current dysfunctionality in the markets. But so what we did here is you buy it here without any stop loss, without anything. And by the way, the biggest swing here, if I'm not mistaken, I think the biggest swing here was due to the non-farm payrolls release at the beginning of February, if I'm not mistaken. I'm not really sure, but I think so. It must be, to be honest, because 1 week earlier we had the 31st of January, so that does make sense. If it's the 7th here, Friday 7th of February, 1 week earlier is the 31st, so it's the first Friday of the new month, which means in this case that it has to be the NFP release, even though it doesn't make a difference, in fact. So what we did here, we bought at 1,566.46, and then we sold $3.50 higher, in fact, here 1 day later at the closing price, respectively, 1 minute before the market closes. We bought the position and we sold it, or we exited it here 1 minute before market closed and went into the weekend, in fact. So this is how the setup looks in the real world. And now the question is, okay, but this is too easy. It can't be that it works. And now you will see it does massively, to be honest. So let's have a look here. So I have here a number of trades between January 2003 to February 2020. Oh, so by the way, I'm sorry, I said 20 years, so it's only 17 years. But since the great financial crisis was 2008, so it's still included within here. The number of trades to this date here was 888. The hit rate of this was 57%. Loss rate 43 then. So these two have to add up to 100%. And the payoff ratio, so the ratio between the average gain and the average loss was 108, 109 to 1, in fact, with a max drawdown of 18.6%. So how can we calculate the max DD? That's very simple. We look just at the latest equity high, and then we look at how much the difference between this high to the lowest point until we make new highs in our equity curve lasts. And so the max DD of this approach over the last 17 years, 888 trades, was 18.6%. And now, fasten your seatbelts, look at this. So that's a backtest result I've generated with programming the simple approach in Python. So you just say, I have my data available here. So you look at end of day data. And this is, I didn't even had to pay for this. So you can easily get end of day data for a tremendous amount of time here at each website, if I'm not mistaken. So I went with the data from investing. So investing.com, you probably have heard about this website, and there just go to the goal tab. And there you can type in which time frame you'd like to cover here, and then get the data there. And that's what I just did. I typed in 1st of January 2003, and then go till today, which was February 2020. In fact, so the 7th of February, that was the last day here I took into account here. And then you manipulate the data to the extent that you say, I only look at my Thursday closing price, respectively Friday closing price, take the difference and take it from there. So you just let it run here. So in regards to the axis, yes, something Sandra just mentioned here. So this here, the x-axis, is the number of trades. So you probably irritated because there's 1,000, 2,000, 3,000, 4,000. I haven't adapted it in Python. I just took the screenshot here. So this is given due to the fact that it includes all data which I just generated. So it is not filtering out here the data in between. So I filtered it out with my chart, but I did not filter it out here on the x-axis. So this is the number of trades, and it should end, in fact, here at 888. So the number of trades I was looking at. And so here, this is the equity. So it's generated with one contract, in fact. So it's the equity development, in fact. So one second. Yeah, and then you take it just from there. Exactly. So you have the data, and you program the strategy. You say, I buy the closing price of each Thursday. I sell the closing price each Friday, and that's it. Period. And then you can easily calculate the difference here between the highest point and the lowest point, and then how long it's not showing you how long it takes to make new equity highs, but once you make new equity highs, this is then the max DD you have here within your tested time span, in fact, and this is how you get the max drawdown, in fact. So strategy, again, very simple, and no stop loss still, which is a problem, which is an issue, which why I want to guide you through how to now adapt here accordingly from a risk reward and a risk and money management perspective, how to take this into account here and make this approach fitting your personality and your degree of willingness to take risk, respectively your risk appetite, in fact. And therefore, you can see it already here. I will dig into this a little later. But what we do here in this calculator is, in fact, we enter our hit rate and our payoff ratio, which is in fact 1088. In fact, so I entered 105, but it's not true because here you can see it, it's 108. In fact, so there's a typo from my end, but we will do this. We will run this in a few seconds again so that you can see this in real time. Even in fact, then the equity curve here, equity curves probably get an even more beautiful upward slope because we in fact adopt respectively optimize here our input parameters to a higher level. So it's better for us to have a higher payoff ratio than a low one, obviously. And what we then do is we take 1,000 trades here and we generate 15 different equity curves. So what you get here is the 15 different equity curves which are simulated. And the simulation, the Monte Carlo simulation, is a so-called Bernoulli Monte Carlo simulation. That means you have only two outcomes of the trade. So you give every positive outcome a 1, and you give every negative outcome, a losing trade in this case, a 0. And then it generates here those curves based on different sequences of winning trades, respectively losing trades, in fact. So it plays around with them, and it's like, yeah, it's like you look at it and you have series here, for example, of 13 losing trades or 14 winning trades in a row. Sometimes you have 20 losing trades. So what you get here, and this is the max number of losing trades following each other, yes. And there's also a chance that if you have a positive run, then one equity curve, for example, only has 9 losing trades in a row. And this is what this Monte Carlo simulator does, in fact. So what you've probably already seen is that this is in German, in fact. So let me just, I will present to you now the website where I have this. It's my website, in fact. So if you read through the interview, I'm not sure, by the way, if I mentioned it, and it's probably also nothing to mention or necessary to mention here, even though I do it right now. I wrote 2 books in German, in fact. So, but it's German books, so it's probably not of interest for the English audience, English-speaking audience here. But what I did in the second book here was I thought about how to make this a better experience, a learning experience for someone who's reading the book. Because what I found out, I mean, I have plenty of books and I read through all of them. And then there was also a book I read once from Tony Robbins. You probably have heard about him. And the book was very interesting because at one point he mentioned that he found out, or studies show, that people only read 10% of the book and then they just don't continue reading anymore, but they just stop reading for whatever reason. And that was something I was thinking about, and it was just like wondering, why is that? So why is someone buying a book and then not continuing reading? I mean, there's plenty of time available. And if you have time, for example, to watch Netflix or whatever, then you have also time to read the book in start and end it also. So why is that? And one of the probably best explanations which came to my mind was that the whole experience is probably, especially when it comes to trading, too abstract. So it's well, just imagine we are looking at our screen, and we have, in our case, candles. So it's like yeah, this is a candle which is blue or red or green or red or whatever color you use there, and they are forming patterns, but at the end of the day, you look at the chart and you think you can read something in those candles and the patterns they form, but at the end of the day, it's still very, very abstract. And this is probably something which makes it very, very difficult to dig deeper into this topic and understand what's happening there. And that's probably the reason, especially trading books then, in this case, are not read from the start till the end. So, which, let me come to the conclusion, probably it makes sense to give people a chance, or give people a place they can go to and then use their just freshly acquired knowledge and play around with it and see how, for example, here such graphs play out in the real world, how the so-called expected value comes into play, or let's say how the payoff ratio affects the equity curve once it grows, respectively once it drops or it becomes less than what you should trade with. So why should you let winning trades run and cut losing trades short, for example? And that's the story, long story behind this website. So I built the website, let it build from someone with enough experience to meet my demand here. And so one of the tools I offer here for free, so everyone can go to the website, play around with it, is this Monte Carlo simulator. So if you have questions around what's Startkapital in Euro or what's Anzahl der Trades, I mean, at the end of the day, it's self-explaining. If you play around a little with it, you will easily find out what it means in English too. There's also Google Translator. But if you have any questions, please feel free to ask them. Therefore, we have our Trading Spotlight community here, which is also the link you'll find in the description box, respectively. I will also post it here. If you have any questions around this, also how to play around with this, feel free to just ask your question here. So it's completely for free. It's a place you can come to ask your questions, share your ideas, your knowledge with other traders, ask your questions, and also what's probably of interest. Now we play around with data which I created based on this strategy for gold, but you can also use it for your own trading. So for your own trading strategies. And if you have clear data, if you have a trading journal, a detailed trading journal, you know what's your hit rate, what's your loss rate, what's your payoff ratio. You can also generate here these simulations, these equity curves. And this is something where expectancy comes into play. What can you expect to get out of your trading? Even though it's at first glance, it's only theoretical. It does not include aspects like a learning curve and that you probably learn out of your mistakes. And that's why you cut losers shorter than you put the data in here and you generate simulations based on. But it's the first step to understand what can I expect in regards to my trading. And why is this of interest? Because it gives you mental stability. Because now you won't come to the, you won't have the idea now to say, I expect to become a millionaire with my 5,000 euro account within the next 2 weeks. But you really, you start at a realistic point here, in fact. And that's making you less affected by mental instabilities, which are, or emotions especially, disappointments you will certainly have when you trade the markets. So, okay, long thing short, let's now have a look here. So we start with our capital, which is 10,000. We look at 1,000 trades again. Okay, so we had 888, which is one trade per week, in fact, over a time span of 17 years. So here we are looking at 1,000 trades, which is covering such a period again. And 1 second, please. 1 second, please. Okay. So this is how home office works. It's perfect. So, so we are looking now. We generate different equity curves here. Over this time span over and over again, and just look how winning streaks, respectively losing streaks, occur here. We have a hit rate, we said, of 57%. Remember that? Let's have a look here again at the numbers, 57%. So, and then we have a losing rate, obviously, of 43, which is not necessary to enter because it's the opposite result here. So we look at 15 different equity curves we create here. Now we have a payoff ratio, which is 1,088 to 1, okay? And then we say we have a risk per trade of 1% here. And then we start a simulation and we just see what happens. So it's obviously interesting what we get, obviously. But what's of higher interest is now not here the curves themselves, but what's more interesting is the different numbers we receive, especially when it comes to the biggest max DD we created here within these simulations, and then also the average max DD we generated. So that's very interesting because now we can already get an idea of, should we risk 1% of the equity, or are we probably not really fine with losing up to 15% of our equity. And in fact, that's optimal because it's less than what we've seen here as a max DD in our real example. So which means probably that was just us getting lucky, let's say, and we should start the simulation again. So now you see the max DD comes up to the point. So we had a very, very optimal sequence of winning and losing trades, obviously, which means that the biggest max DD was just very, very low, coincidentally, in fact. Now we have 18.5%, which is very close to what we experienced in the real world. Let's play around again. So you can click this as often as you want. And now you can also see, oh, 1% risk, 20.8% max DD. And that was already after hitting the button the third time, which means you probably should expect to see a max DD if you trade the strategy without a stop loss, without a take profit, and especially in regards to the stop loss of over 20% when risking 1% of your equity. Are you fine with that? That's the question I can answer for you, but you have to answer it for yourself. So if you say, no, that's too much, I want to reduce this number, since you're working without a stop loss with the basic strategy, you have to reduce the risk per position you take. And this is how an adaptation based on a Monte Carlo simulation could work and could look like, in fact. So you can, again, you can click as often as you want. Now the fourth also delivers a max DD of 21.3%. Let's see. Now it drops again because it's a very optimal optimal sequence here of winning respectively losing trades for the approach. Now, what we can already conclude is that probably we should expect when risking 1% of our equity, the max DD should be somewhere around 20 to 25%. That seems to be a realistic approach, in fact, and something you should keep in mind. And if you're not fine with that, again, the only chance, since we're not working with a stop loss, is reduce your position size. Reduce it to less than 1% per trade you're losing, in fact. Yeah, so in fact, that's it, in fact. So nothing more to say here on this topic. So let's sum everything up. So probably that's a good idea here. So gold, obviously, as I've showed to you, can be profitably traded with one trade per week. And in fact, in a very, very easy way, go long on the closing price each Thursday and close the position one day later at the closing price of Friday. So the reason for that, as already described in an, let's call it again, normal market environment, can be found in risk aversion, which is usually a factor with looking at the weekend, which is right ahead of us, and market participants want to hedge their exposure, respectively, buy some insurance to some extent. In addition to that, there's also potentially a reason from the physical gold market, which comes into play here. That's in fact it. So certainly I can guarantee that here, this is also a result which you will see in the future, and that you will see a rising equity curve. But it's something which makes sense and which has worked out pretty well over the last 17 years, as you've seen in the backtest. And so it's probably a first great step to trade gold in the future from a profitable perspective, knowing that you're in at least a trade which has proved quite stable and proven profitable over a time frame which is way above 10 years. Again, nevertheless, the problem of the strategy is that it works without a stop loss. And that's why it's so important that gold is a very liquid asset. And again, with the help of Monte Carlo simulations here, as shown, and further backtested data like the max trading range within the traded time frame, for example, you could work with an emergency stop loss, respectively. If you don't want to work with it, but just go with the basic strategy, it makes probably sense to reduce the position size and thus help. It's, by the way, also something I probably should show you. Once you reduce your risk, even though it's obvious that this should work the way, but let's go down to 0.5% per trade. So what you will see is that here, the max DD is now down to a range around 10. So 10%. It's even sometimes lower than that. This is probably realistic, 15%, but seems to be the upside. At least once you click here on the simulation start simulation, tap here several times. So now we did 10 times, whatever. So it was more around 9 to 10%. And if you can stabilize, this is also something which is of importance here. If you can stabilize the hit rate and the loss rate, certainly, and the payoff ratio, but this is something you can't really affect, since it's in fact, yeah, to some extent, automated strategies, automated approach. So yeah, that's it. That's it on the ideas in regards to the risk and money management. Don't forget to join us next time. So at the same time on Monday, Paul will guide you how to the question how a pro trader uses the MT4 in his own trading. Here you will learn how Paul sets up his own trading templates, how and why Paul creates profiles for himself, and also how Paul uses Fibonacci, especially to help him with the trade setup and to optimize potentially the entries into his trades. Time, it's the same. So if you're here right now in the live event, then you will get an email to your inbox, and you can just join the webinar as you did today's webinar. It's Monday, 2 p.m. London on the 30th of March. And yeah, check your inbox for the webinar link, respectively. If you watch the video now on YouTube, go to the website, admiralmarkets.com, and there to the top education, and there to the webinars tab. And there you can also register for the Trading Spotlight webinar series. And this is the website. You will find further information. admiralmarkets.com. Here are the contact details of Admiral Markets, and I said it already at the beginning, and that's why we will end the webinar with this here, the risk disclaimer. So that's it from my end. All the best. Happy trading. Watch your stops. I hope you enjoyed this webinar. Please, if you watch this on YouTube, leave a thumb up, probably would be nice, much appreciated. All comments, please use the box here below the video, respectively, our Trading Spotlight community, and have a nice weekend. Enjoy yourself, stay safe, and talk to you soon. See you.